Welcome back to the Mortgage Moment. Hi, this is Mike Seeley, your loan genie, with Demystifying the Loan Process. And today, as I said, we're going to talk about adjustable rate mortgages and the caps on those adjustable rate mortgages. To review, a fixed rate is generally somewhere up here that's fixed. Here's a 30-year fixed rate we show up here. And our adjustable rate is generally lower. And it's made up of two components, as we remember. The index we choose up front and the margin we choose up front. And it changes periodically. The index will change periodically, but the margin will stay the same throughout the life of the loan. How high can that go each period? And that's what we want to talk about today. The caps. What are the limits on your adjustable rate mortgage? And again, remember they change periodically. Now, what can those periods be when the index is readjusted? They can be 1 month, 3 months, 6 months, or 1 year, or any number of different time periods. But whatever that periodic event is, you want to be aware of. So, our first cap comes in the periodic cap. Now, in reality, the adjustable rate will start a lot lower than the fixed rate options, generally half. So let's adjust that right now. There we go. There's more of the margin index at the beginning rate, starting almost half what the normal fixed rate is. So let's look at the second period. Here we see the second period, whether it's 1 month later, 3 months later, 6 months, or a year, moving up because the index moved up. Remember, the margins stayed the same. But how much can that total adjustable rate move up? That's the first cap, the periodic cap. Here I show the periodic cap by this brackets here. The first period or any period cannot jump any more than a certain number. Let's call it 2%. It's often 3, 4, or 5%, and that's also something you predetermine. So the periodic cap cannot go, the index cannot go any higher than this on a period. As you saw, it's within those ranges. Here we see in this third period that the periodic cap was exceeded. Now I've shortened it to make it more visible, but as you can see here, the previous index amount and the next period index amount has exceeded what you should be allowed on the periodic cap. So what happens when that occurs? The periodic cap brings the rate back down to be in compliance with the maximum it can be for any period. And there's also a reversal periodic cap where it cannot go any lower than a certain amount. Again, that could be a percentage of the current index, or it could be the full rate, like the rate can be no more than 7% increase, or 5% increase, or 2%. Obviously, the lower, the better for your periodic caps. Every period, the total amount cannot exceed a predetermined amount. That helps you avoid payment shock. Next, there's what we call a lifetime cap, or life of the loan cap. And that means that the loan can never exceed this given interest rate, or index plus this amount, or margin plus this amount for index, depending upon what they tie the cap to. But it gives you an idea as to what is the worst that could happen over the life of the loan. And let's take a look at that. Here you can see the lifetime cap, and generally it is pretty high. It's definitely going to be over what your fixed rate would be, because there would be no benefit to having a fixed rate or an adjustable rate in that case. And your total payment cannot exceed that amount, because if that did, say, on the next pay period, here's what would happen. Here I've removed the periodic cap because it has clearly exceeded. But say this is the 8th or 10th and it got up to this rate. As you can see, it exceeded our lifetime cap here. So what happens? It moves back down. And you'll come in compliance with your lifetime cap. So at your next adjustable rate mortgage, understand these and know these and find out what they are. Very rarely do people find this out. Very important is your periodic cap. What is the near future consequence of your adjustable rate moving? And then lifetime cap. What could it possibly get to? Now, honestly, most people consider an adjustable rate mortgage as a temporary loan. And by temporary, I mean 2, 4, 5, or 7 years. And that they'll refinance perhaps or move before then. But know those so you know what your exposure is. Know what your risk is. And then you can weigh it against the more traditional fixed rate or taking advantage of the lower adjustable rate startup, allowing you to qualify or have better cash flow. Well, again, this has been Mike Seeley, your loan genie, from Demystifying the Loan Process. And again, if you've got some more questions, just go to askyourloanquestion.com or visit Demystifying the Loan Process at yourloangenie.com. Thanks for watching The Mortgage Moment, and see you next week.